Hello, everyone. We're so glad that you've joined us today. We have a fabulous program, a lot of information. The program itself is going to be approximately 60 minutes, and we will have time for Q&A at the very end of the presentation. If you do have a question, we will take questions at the very end of the presentation. We ask that you please type your questions in the Q&A box. You'll see this icon at the bottom of the screen. If you just type in your Q&A, we're going to do our very best to get to all of your questions. As usual, we have very important disclosure information. We have 2 pages of this. This is a requirement, of course, and just for your clarification, we are recording this presentation. We will have a recording along with the slides that we're showing you today, and that will be sent to you by email sometime, hopefully by the end of next week. These are our 3 wealth advisors here at Dechtman Wealth Management. I call it the power of 3 or our triple coverage. We are a family business. We've been around, going on 38 years now, and we are very honored and very grateful for the opportunity to work with you. We couldn't do this alone without our wonderful staff, and many of you are very familiar with them, and here they are here on a beautiful spring day. Okay, so now let's get into our agenda. Sam is going to be presenting our discussion today, and he's going to be covering these areas. The pandemic and COVID, which is an obvious number 1. Another topic is interest rates and inflation, what's going on in the labor market. And this couldn't be more current than the Russia-Ukraine conflict and what's happening there and how it impacts the markets. And something that hasn't gotten much attention as of this moment, but it's very important when we look at the market related to midterm elections. And then we're going to give you a whole host of strategies and talk about our outlook for 2022. So on that note, Sam, take it away.
All right. Thank you for that introduction, and thank you all for attending our presentation today. As Jordan had mentioned, we'll be covering many important topics. Our goal is to provide you with as much information as possible, and so some of the items we'll be discussing today are extremely complex, but we hope to present the information clearly so you have a better understanding as to where we stand now and what we believe could potentially lie ahead. So let's just jump right into it. We'll begin by discussing the pandemic, current COVID situation. So what we're looking at here is a chart which shows our progress towards immunity. And what we can see is the number of folks here in the United States that have been vaccinated, that have been estimated to be infected, although they were vaccinated, and then folks that have just gotten COVID over the course of, the the current pandemic. So as you can see, the latest reading here in December, based on the data that we've seen, shows that roughly 90+% of the United States has some sort of antibodies one way or the other. So we have far reached that threshold that we had heard very much at the beginning of this thing, such as herd immunity. And so when it comes to the current Omicron variant, we're seeing that the COVID mortality rate is going down pretty significantly. And so this shows a chart from May 2020 through the end of December of last year. And thankfully, many cases, of mortality have been going down pretty significantly. As a result of more folks having those antibodies and this variant proving to be less deadly than the previous variants, many states are starting to open up, whether that means that they have currently lifted their mask or vaccine mandates, or they are going to in the near future. Here's a list of states that had, previous lockdown restrictions. So Colorado, New York State being the big one. However, there are certain jurisdictions within these states that are still abiding by those localized rules. So New York State is open, New York City is still requiring that vaccine mandate, New Jersey, California, Connecticut, and some of the other large states that you're seeing here in the right-hand column as well. So it's very encouraging that folks are not only doing much better in terms of staying healthy with the new variant, but states are answering in turn, and folks are getting out and starting to experience some of the things that they've had to put off for the past 2 years. So now I want to talk to you about inflation and interest rates. We're going to first start by looking at interest rates, and what we are looking at here is a chart which shows the U.S. federal funds target rate going back from 2000 all the way until the beginning of this year, 12/31 of last year. And so interest rates, as you can see, are at historical lows. And the market right now is pricing in that the Federal Reserve may be increasing interest rates 150 basis points to 175 basis points through rate hikes in 2022. Said a little bit differently, they're planning on increasing the federal funds rate to 1.5% to 1.75% in terms of the short-term rate. If the Fed raises interest rates at 25 basis points a pop, or 0.25% at each meeting, that means that they'll raise 6 times on the low end in terms of what the market is expecting. We believe that is probably higher than what the Fed will actually end up doing. We believe we could see 4 to 5 rate hikes this year, for a total of roughly 1% to 1.25% increases. Now, we're going to be getting into just a moment the inflation numbers, but a reason why we're seeing the Federal Reserve want to raise interest rates is because inflation is very, very high on a headline inflation number, and we're going to be making the clear distinction between headline inflation and core inflation, which are those goods that don't have as wild fluctuations. But in addition to inflation, the economy is doing very well. And so the Federal Reserve needs to start to loosen some of these easy money policies that have been in place, as you can see, over the course of the pandemic. So just to give you an idea, we wanted to show you what the chart of the 10-year U.S. Treasury has also looked like over this same period. And so you can see that here we are on the right-hand side, and this was through the end of December of last year. The 10-year U.S. Treasury is still very low compared to the past 20 years, and certainly low from a historical standpoint. So when the Fed is raising short-term interest rates, that doesn't mean that you're going to see the 10-year U.S. Treasury or other types of bonds move in lockstep. So said a little bit differently, if they're going to increase rates 1% or 1.25%, that does not necessarily mean the 10-year will move up 1% or 1.25%. In fact, we think that bonds that are a little bit more in the intermediate or longer term area will be moving up a little bit less, because we're already seeing data and statistics that in the bond market, these longer dated bonds, investors are already pricing in lower inflation as far as looking many years out into the future. So what is causing some of the reason to raise interest rates is really inflation, and what is causing some inflation has to do with supply chain issues. So I want to touch briefly on the supply chain issues, then we're going to be getting into the specific inflation numbers. So what we're looking at here is a chart which shows the vessels in queue at the port of LA and Long Beach from the beginning of 2019 through January 19th of this year. And you can, of course, see how that trend has been increasing exponentially. So today's delays begin before ships even pull into a berth. Ships are unloading much more slowly than usual because the containers are hoisted onto docks aren't moving inland fast enough. Instead, they're sitting on the port property for weeks as warehouses and container yards across the region overflow. E-commerce boom fueled by the pandemic has meant more cargo entering the US than ever before. But once dock workers unload containers full of Asian-made goods, the lack of yard and warehouse space to store them often leave the metal boxes with nowhere to go. From there, a shortage of truckers and chassis is also making matters worse. The US is currently lacking about 80,000 drivers, according to the American Trucking Association. At the same time, chassis are also scarce, with many stuck under empty containers while tariffs have made it more difficult to import new ones from overseas. For trucks that are showing up to transport these goods, the corridor can't fully accommodate the thousands of trucks that navigate the region every week. As a result, heavy-duty trucks often drive by residences and schools to avoid the congestion, which is causing other issues. So to summarize the issues here, what's happening is boats are having to stay out at ocean for longer because they can't unload their containers because there's not enough equipment to unload them. And in terms of trucks getting into the port, there isn't enough room and there's a huge bottleneck. So at every step of the process between getting the goods into the ports and actually getting those goods transported across the country, there are some issues. And as a result, another key factor clogging the supply chain outside of ports is the warehouse crunch across Southern California, where vacancies in the existing $2 billion square foot market are near 1%, and rents have jumped 30%. In the Inland Empire development east of Los Angeles, about 20 million square feet of new space is under construction in a market that still needs 50 million square feet to meet demand. Why is there still such a deficit? Well, more supply chain problems, of course, including delayed shipments of building materials like doors and conveyor belts that are stalling construction. So not only is it taking longer to get the goods that you need, we're also seeing that shipping rates are going up exponentially as well. So now I want to take us into inflation. So how is this showing up here in our society? So this blue line that is moving across the screen shows the year-over-year change in the consumer price index for all urban consumers in the US, or just inflation. And this orange line that we're seeing moving across the screen is the 3-year average. And so what's very important to keep in mind is on a 3-year average cycle, the overall inflation isn't that much above what our average has been or the long-term average of inflation in the United States, which has averaged a little less than 3%, about 2.9. So what's important to keep in mind is not to be fully focused on these headline year-over-year numbers, but really taking a deeper dive into what is causing this. So let's do that right now. What are the biggest sources of inflation change? Well, you can see right there at the top, and I'm sure that this is no surprise to anyone, but the largest source of inflation has been gasoline, natural gas, so energy in general. If anyone has tried to purchase a new car or a used car, they know how difficult that has been. Another supply chain bottleneck has been the semiconductors or the chips that go into the cars. The majority of these semiconductors are made in Asia, and while the US is beginning to open up, during brief periods in the pandemic, China has had a zero tolerance policy. So they have shut down factories and entire areas of the country for weeks, or even longer than that, even up to a month. So when the supply chains are starting to get back on course, if there happens to be a particular case in a factory, China will shut that down for an extended period of time, just further causing issues to bubble up. But another item that I want to point out to you, and you all probably notice this when you go to the grocery store, is food. Food is up very significantly. So in terms of the items that we are seeing increase inflation significantly is energy, cars, and food. So now let me kind of show you inflation in a slightly different way. So what we're looking at here in this graph is what we call sticky versus flexible price changes on a year-over-year basis. And this goes all the way back, to the late 1960s to where we're at now. So you might have seen articles at the beginning of these inflation issues, or maybe even currently, saying that we are potentially going to be in a 1970s type of inflationary environment. But as we've kind of circled and drawn attention over here, we don't think that we are in the same type of issues as back then. So you can see that the sticky inflation numbers are much lower at about 3.4%, and the flexible is much higher. So let me define what both of those mean. So sticky inflation tends to have longer staying power, and this includes categories such as rent, insurance, and medical expenses. And flexible inflation are the three items I mentioned before: food, energy, and cars. And that has risen much faster in recent months, but we believe that it will not continue to maintain its current pace. And those three items alone have contributed the most significantly to the increased inflation. The other items, by and large, have gone up, of course, but not nearly to the extent that we're seeing on that front. So to kind of conclude where we're at with inflation, overall, inflation is higher than what we've seen historically, and it is difficult to determine when we're going to get back to where we were pre-pandemic. But there are encouraging signs that we're hopefully working through changes that by the second half of the year, maybe we start to see the situation ease, as well as the increasing in interest rates. The hope is also that that will begin to tame inflation. Now let's talk about the labor market, which is another area that has drawn a lot of focus and concern, and one that we're paying particularly close attention to. So what we're looking at here is the number of job openings on a monthly basis. And this goes back from 2012 all the way through the end of December. I apologize, the graphic is a little blurry, but hopefully you can see the trend, because that is the most important item. So what I want to draw your attention to is the large number that we're seeing here on the right-hand side. As it was last reported, there is between 10 and 11 million job openings in the United States. Right now, it's estimated that there's roughly 6 to 7 million people looking for jobs. So that is a gap of 4 million people between job openings and folks that are looking for jobs. That is the largest increase that we've seen on record. So getting these folks back to work is something that will really help propel the economy and continue providing this growth. But what we've seen, and you've probably seen a lot of headlines on, is about the Great Resignation, if you will. So this is a slide which shows the number of times workers quit per month. And this goes back from 2010 all the way till December of last year. And what you're seeing is the graph also increasing at a very large rate. Now, the largest category of folks that are quitting their jobs are older Americans. As baby boomers are nearing their retirement, some have been given retirement packages, or maybe they have just decided that enough is enough and time for me to start enjoying life. But there are other large subsets of the economy where folks are quitting. In fact, teachers are one of the largest areas that we're seeing right now where they are quitting their jobs and actually moving to other industries. And there's a lot of other industries which are going after teachers specifically. Another area that we're seeing a lot of quits in is the service sector. And last but not least, the retail sector, excuse me, is we're seeing a huge exodus in healthcare, specifically nurses burnt out from the bedside. So our teachers, our retail workers, and our nurses are three of the biggest categories of folks that seem to be looking for other opportunities. So as a result of many folks that are retiring and many folks quitting their job, I wanted to show everyone what we're looking at from a labor force participation rate. The labor force participation rate shows the percentage of the population over the age of 18 that is working or looking for work. People in the US military, jail, or nursing homes are not included. So as you can see, this trend has been getting lower since 2008 for one of the reasons I just mentioned is that boomers are reaching their retirement years. One encouraging trend, which is not visible here, is the labor force participation rate for prime age workers. It's those that are between age 25 and 54. That statistic has ticked up to 82%, which is just a notch below where we were the pre-pandemic in terms of where it was. It was at 83% in terms of prime age workers. So overall, there's less members of our population that have been working and continuing a trend that has begun since 2008. But in terms of those prime age workers, we are seeing that, slowly recover. So in terms of, getting more folks that can work back to work, as I mentioned before, that is going to be something we're paying close attention to, because the more folks that are working and contributing to the economy in a meaningful way will, of course, help us down the line in terms of what growth looks like. So now we're going to switch topics completely and talk about one that has been in the news lately, and we think will probably be in the news for the foreseeable future. In fact, we just saw a promising headline today that Russia has backed off slightly, but it appears to be a mixed message. So let me just get into our explanation of what's happening now and what we think the implications of this might mean. So this issue is very complex, and I won't be able to get into all the nuance, but I'm going to do my best to discuss this at a very high level. There are deep historical ties between these two countries, so much so that Putin believes that Russians and Ukrainians are one people. The recent tension between the two countries has escalated for several reasons, and the true verdict probably lies somewhere in the middle. Russia has demanded that Ukraine never join NATO, which is the North Atlantic Treaty Organization that the US is a part of, and that NATO pull back forces from Eastern European countries that joined the alliance after May 1997. The US has not completely ruled out allowing Ukraine to join NATO, which has upset Russia. In response, Russia has sent 100,000 troops along Ukraine's borders in a show of strength. And if you look at a map of NATO countries, I think it will become a little bit more clear maybe why Russia is threatened by the potential move of Ukraine joining NATO. You'll see on almost three fronts, they would be completely surrounded by NATO countries. So as far as financial markets are concerned, a Russian invasion of Ukraine could boost global energy prices. Russia supplies nearly a third of the natural gas consumed in Europe and accounts for over 10% of global oil production. Any shutdown or threatened shutdown of these supplies would push prices higher from today's already elevated levels. We do not know how this will play out, but we'll definitely be watching it closely. Now, here is a chart that shows past geopolitical events dating all the way back to Pearl Harbor. As you can see from past wars, assassinations, terrorist attacks, other crises, they are usually short-lived. Any downturn caused by a rise in tensions, we believe, will be viewed as a buying opportunity. So that doesn't mean that we're going to not That does not mean that we are not going to have any short-term fluctuation. In fact, today's headline was positive because there was a mixed message that maybe Russia is backing off, and we see this continuing on for the foreseeable future until there is some meaningful breakthrough. So just wanted to show you the statistic of all the previous events here. So now we're going to be talking about midterm elections. We are not going to be making predictions. We are not going to be telling you what policies we favor and which ones we do not. We are going to be looking at this purely from a financial perspective as to what the results could tell us, what we should be paying attention to, and what we should not. So one thing that we've seen from the data is that midterm election years have been more volatile. So in the navy blue bar columns, you'll see the midterm election year volatility. The larger the bar is on the screen, the more volatile it is. And then you'll also see in the sort of teal color, the volatility on a particular month in all other years. And as you can see, pretty much throughout the board, I'd just quickly scanning, I'd say about 10 out of the 12 months during a midterm election year, on average, the volatility is higher than in all other years. And I would say that this year has already played out to that. The market has been focused on all of the different headwinds and areas of focus that I mentioned before: interest rates, inflation, midterms, Russia, labor market, supply chains, all of that. And so what the market is not, or shall I say the media hasn't been entirely focused on yet, is the midterm elections. But as we all know, we will be flooded with commercials and other advertising. So in the fall, we expect it to tick up. And as you can see, and I think maybe intuitively we know, October, somehow volatility during midterm years seems to spike. And we all know that is when politicians are making their last push to try and convince you. And unfortunately, that's probably when they're spending time bashing the other side and causing fear. So we just want you to be aware that it is typical that in midterm election years to experience more volatility. Now, another item that we have typically seen in the past is that the president's party typically loses seats in Congress. Now, the president's party is what the column is, colored. So a Democratic president, the column would be blue. A Republican president, the column would be red. And as you can see, going back to 1934, it is often that the president's party loses seats in Congress. So if that should happen again this year, we would not necessarily be overly surprised just based on the data that we've seen. So what does it actually mean in terms of the results? There's nothing wrong with wanting your preferred candidate to win, but investors can run into trouble when they place too much importance on election results. That's because historically, elections have had very little impact on long-term investment returns. You can see what happens on average with a unified government, a unified Congress, and a split Congress. All have done well, and a split Congress actually seems to have done the best of those three. So while you may be leaning one direction or the other, certainly feel that making investment decisions based on your political preferences is not the best strategy. So now I want to move forward and look ahead as to the outlook and strategies to consider for 2022. This chart is going to show us how impactful dividends have been over the long term. So going back from 1980 through the end of 2020, this shows the growth in the light blue of a portfolio invested in the market that's reinvesting dividends, and the navy blue shows the total portfolio value without reinvesting dividends. And you can see over the past 40 years how significant of a difference this is, almost a 3x type of growth when dividends are reinvested. Another reason why we like dividend growers in particular is because these companies have particular characteristics that we think are very favorable for where we're at right now in the market. Dividend growers, by and large, have great free cash flow. What that means is they are able to continue to fund operations and grow without having to fear of stopping the train because there might be disruptions that another new variant or geopolitical issue might throw out there. Companies that continue to grow their dividends have also experienced lower volatility over time based on their peers. And as we had discussed before, we think that this year will certainly provide its own fair share of volatility for a lot of different reasons. And another aspect that we really like these for is most dividend growth stocks are considered value stocks. So a growth stock would be the opposite. A growth stock is a stock where the expectation of growth is pushed out into the future. Investors believe that they will be reaching their potential at some point in the future, which is years from now. Dividend growth stocks are already generating profits. They're already generating substantial cash flow with the idea that they will continue to grow over time as well. So it's a great strategy to take advantage of the different valuations that we're seeing, potentially limit volatility, and provide for those dividends over time. On the bond front, we think that a good opportunity there could be municipal bonds. So let me first quickly describe what a municipal bond is. A traditional bond, if you will, is issued by a corporation. And the interest that the bond pays when you buy a bond from a corporation is fully taxable at your marginal income tax rate. With a municipal bond, these are bonds that are issued by states, municipalities, so the state of Colorado, the city of Denver, the state of Louisiana, whatever municipality you can think of, and they are to fund public projects by and large. So hospitals, toll roads, airports, water and sewage facilities. And so if you are a resident of Colorado and you are in a municipal bond that was issued from the state of Colorado, it will be federally tax-free and state tax-free in most circumstances. Of course, there are some exceptions to that, but by and large, federally and state tax-free. So if you're at a stage right now where income is a major component, doing it in a way where you're getting tax-free or mostly tax-free income could be a substantial advantage. And what we've seen over time is that the municipal bond market has been very resilient. So one area that I want to actually draw our attention to is 2015 through 2018, where the federal funds rate was increased, which is where we're talking about now. And as you can see, over these 4 years, municipal bonds were positive each year. And then if we come back a little bit farther, 2004 through 2006, where the Fed funds rate increased 17 times, you can see that each of those years, it was also positive. Now, we're not saying that municipal bonds will absolutely be positive this year, but looking back through all of these different instances, and maybe you've had some time to read at the moment, you can see that they are very resilient. And states have also increased revenues by and large significantly over COVID, as well as receiving large checks from the federal government. So on the fixed income side of things, municipal bonds are another area that we think would be wise to potentially turn to. So where we're at with the stock market right now, wanted to take a longer term approach. So over time, stocks have generally followed earnings. And what we're looking at here is sort of overlaying charts. The green line that we're seeing shows us the S&P 500 index, and the blue line shows us the S&P 500 earnings per share over the last 12 months, or said a little bit differently, it's showing us the profits of the companies within the S&P 500. As one of the most famous investors of all time, Benjamin Graham, said, in the short run, the market is a voting machine, but in the long run, it's a weighing machine. What matters in the long run is a company's actual underlying business performance and not the investing public's fickle opinion about its prospects in the short run. So there are periods where you will see a dislocation. You can see that they do not line up perfectly, but by and large, the S&P 500 index has focused and shows the greatest correlation to what the earnings of companies are. What are they actually doing, and how are they performing? So what could we expect in terms of earnings moving forward? What we're looking at here is the S&P 500 earnings per share going back to 1988 through the end of 2021, as well as showing some projections as to what 2022 and what 2023 could hold. So, and 2021 is this first blue chart because we hadn't received all of the data at this point. Earnings have recovered spectacularly since the big declines in early 2020 and hit a new all-time high in 2021. This partly reflects stellar profits in some of the most important sectors of the U.S. equity market, such as technology and healthcare throughout the pandemic, but also a rebound in many of the cyclical sectors that struggled the most last year. More generally, earnings have been bolstered by a powerful consumer demand and higher productivity as businesses have been able to reduce costs in a more virtual environment. However, from 2022 on, slower economic growth, higher wage costs, higher interest rates, and potentially higher corporate taxes could make further profit gains much more difficult to achieve. But as you can see, many of the estimates for 2022, which is the second from the right blue chart, in 2023 are still positive. So while everything that I've mentioned before has been pointing to issues that are involved in the market one way or the other, the ultimate consensus, at least among most analysts, is that profits should continue to increase. So let's go back and let's look at how stocks and bonds have performed 12 months following the first Fed hike. So U.S. stocks are up on average 7.3% in the 12 months following the first Fed hike, and bonds are up 3.2%. So again, I want to go through the dynamics of why the interest rates are going to be increased. Interest rates are being increased twofold: to try and cut down inflation, but also because the U.S. economy is showing strength. It is showing that it does have the ability to stand on its own two legs. And a major part of that inflation issue is a result of what is happening on the supply chain front. So if we can clear that queue at those ports, if we can figure out how to boost production in semiconductors, if we can figure out how to produce and get these supply chains working again, that will have massive effects on inflation. And so maybe the Fed will not need to necessarily increase as much as the market is necessarily suggesting at the moment. But let's look at past growth scares as well as bear markets. We're looking at everything from Black Monday to the sell-off of, COVID in 2020. Now you hear Jordan, myself, and Adam talking to you, sending letters about trying to look at the forest and not getting lost into the trees and really trying to take a step back from our current period. You could pick out any one of these particular areas and they've all presented their own unique circumstances. But if you look at what happens the 12 months following a particular event, which we felt, some folks might have felt was, overwhelmingly bad, you can see how resilient the market becomes. So it's very important that we take each individual item on its own merits and not try and be too swayed in either direction. But instead, let's look at the bigger picture here, and that we think there's a lot of positive momentum for the companies here in the United States, and with states opening up, mortality is going down, inflation hopefully turning the curve here soon. We do think that there's a lot of very positive indicators happening at the moment. So let me turn it back over to Jordan to talk about next steps and to bring us home.
Sam, thank you so much. Okay, so let's kind of wrap up. Let's talk about the next steps. And the first item that that I want to call your attention to is putting cash to work to offset inflation. So Sam talked about a couple of strategies that would be good possibilities. One are municipal bonds. The other are the dividend growth strategies. We think in this environment, the opportunity presents itself. It's absolutely worth taking a closer look at, and something that we would strongly recommend, both dividend growth strategies and municipal bonds. Obviously, it's going to depend on your situation, but this is something that we can go over more specifics, more details with you as we talk and get together. Another item that seems to come up all the time is reviewing beneficiaries. We would like to strongly recommend, as we kick off 2022, this is a good time to sort of look at your accounts, your beneficiaries, make sure everything is properly up to date. And lastly, if we haven't talked in a while, we would love for you to come in, or we can talk on the phone, or we can do a Zoom meeting. It's imperative that we make sure you're on track, and we would like for you to give us a call, schedule an appointment, and we would welcome that as soon as possible. Okay, so at this point, it looks like we already have quite a few questions coming in. So why don't we get to the questions? And
yeah, definitely remember, if you haven't entered your question in, to type it in the Q&A box, and we'll try and address as many as we can.
Okay, so the first question here is, okay, this is a good one. When can we expect to receive our 1099 tax forms? That's a good one. So depending if you had National Financial Services in 2021 and Schwab in 2021, they're both a little bit different. But the general response to that question is you will have all of your documents by the end of the month. Schwab is going to be mailing the documents this Wednesday, February 16th. If you need any assistance in obtaining that, you can call our office. We're always happy to help, or you can go online and download that after this Wednesday, February 16th. Okay, so another question, Al G. He had asked our thoughts on cryptocurrency. Sam, you wanna take that one?
Yeah, I'll take this. Thanks, Ray, for the question. So we've talked about this in the past, and I'll kind of say our thoughts in a slightly different way. The cryptocurrency market is now, or I guess industry, if you'd like to call it that, is now a multi-trillion-dollar area. Bitcoin, Ethereum have started to become household names, and there's also many other types of tokens, NFTs, other types of businesses that are spurring a lot of the growth on what is being called the Web3 or the blockchain. We believe that the blockchain is going to completely transform the world. But in terms of investing opportunities, right now the cryptocurrency space is still the Wild West. Bitcoin and Ethereum are two of the largest players, but that does not mean that they will continue to be the largest players. As we've seen in many other industries, just because you came first does not mean that you are going to be the dominant player forever. For example, when it came to the age of the internet, who still uses Netscape? I'm still waiting. Exactly. They used to be one of the largest players when it first happened. And so we don't know yet who's going to be the winner and the loser. So if this is something where you are interested or going to get involved with, let's talk a little bit more about it. But the risk is still substantial as well due to different industry or lack of different industry regulations. Hopefully that'll kind of settle the dust from what right now is quite frankly, is the Wild West.
Okay, we have another question. Are you worried about government debt levels after the trillions of dollars pumped into the economy? Sam?
Yeah, so that's actually another interesting question. And I recently read a white paper which discussed this topic specifically. And what they found when looking at debt levels is the traditional way of assessing a country's indebtedness is looking at the debt to GDP ratio. And what they have found is that a country's debt to GDP ratio wasn't necessarily incredibly indicative as to what the outcome was going to be. So for example, there have been countries that have defaulted when their debt to GDP ratio is about 70%. We've also seen countries where their debt to GDP ratio is roughly about 200%, as we've seen in Japan. Now, the printing of monies and the ballooning of our debt is definitely something that we want to keep an eye on and would like to not have it continue to expand, but we don't necessarily feel, particularly based on this research as well, that just because our debt to GDP slightly over 100%, that we're necessarily headed for doom. So, it's a long-winded way of saying, unclear, but as long as the United States continues to be the financial bedrock of the world and the most important country, we think that things should hopefully continue on a good path.
Okay. A few more questions here and then we'll wrap things up. So we did get a couple of questions relating to someone's individual situation, and we never want to comment on an individual basis. That's something that we need to talk specifically with you on the phone or in person. And obviously, we've seen a lot of volatility and a lot of fluctuation. I thought Sam did an excellent job addressing some of these issues and recognizing that those setbacks are temporary, and we don't want to look at this as a voting machine, but rather a weighing machine. And we take a long-term perspective, and that's really important. But I would, again, strongly encourage you to call the office, schedule a time for us to talk on the phone or meet in person so we can go over your individual situation. One other question here: what's our view on international stocks and the benefit of ownership? So I'll take that one, Sam, if you have anything else to add. We are strong proponents of international investing. We believe the economy is global, and the US GDP, if you will, or the global GDP as a whole, the US represents on average about 70% plus or minus of that global GDP. So that means, or I'm sorry, I have that reversed. The US represents about 30% of the global GDP. and means that there's tremendous opportunities outside. So international investing is a very important piece. It's a part of a well-balanced, well-diversified portfolio. Sam, any other comment to the international or next question?
Yeah, I suppose just to kind of clarify a few points. We believe that having some international allocation is very important from a diversification standpoint, as well as making sure that we're taking advantage of opportunities that are outside of our home base. But in terms of where we feel right now is the best place to be, we view the United States right now as the best environment for new monies. But yes, the international space, has a lot of very compelling components from a valuation perspective. It's very enticing, but we want to see a catalyst in terms of, when we think they're going to turn the ship around before we start allocating additional monies there.
Okay. Well, goodness, the questions keep stacking up, and I think we're pretty darn close to our time here. Yeah, I'm gonna kind of cut it there, and unfortunately, we are not going to be able to get to absolutely everyone's questions. We will do our very best to follow up with you individually, and again, we want to thank you. We are grateful for your friendship and for your trust and confidence that you have placed in us. Please give us a call. Please schedule an appointment. We'd love to meet and look forward to talking to you soon. Thank you. Have a wonderful day. Bye-bye.
Thank you.